Hello, and thank you for the opportunity to speak to you today. I'm Fariba Nasseri, an Associate Chief Accountant in the Professional Practice Group, or PPG, within the SEC's Office of the Chief Accountant. I'm joined by Vasilios Karapanos. Vasilios, would you like to introduce yourself?
Hi everyone, my name is Vasilios Karapanos, and I'm also an Associate Chief Accountant in the SEC's Office of the Chief Accountant. We would like to thank the PCAOB for providing us the opportunity to speak at this event. Fariba, before we begin, could you please provide our standard disclaimer?
Yes, we'd like to remind you that the views both of us express today are provided in our official capacities, but do not necessarily reflect the views of the Commission, individual commissioners, or other colleagues on the Commission staff. As always, I thought maybe we can start by providing a brief overview of the Office of the Chief Accountant, and my apologies to those who have heard this information before. The Office of the Chief Accountant, or OCA, not to be confused with the PCAOB's Office of the Chief Auditor, is led by Ryan Wolf, Acting Chief Accountant, who serves as the primary advisor to the Commission on accounting and auditing matters arising in the SEC's administration of federal securities laws. Everything we do in OCA is anchored in the SEC's three-part mission to protect investors, maintain fair, orderly, and efficient markets, and facilitate capital formation. Our work spans from big picture thinking about the overall financial reporting ecosystem to impacting the structure and governance of various groups in the ecosystem to weighing in on detailed day-to-day accounting, auditing, and the many related legal issues. Our office is divided into four major groups: accounting, professional practice, international, and Office of the Chief Counsel. Vasilios, would you like to walk us through the responsibilities of the four groups within OCA?
Of course, Fariba. The Professional Practice Group advises the Commission on audit, internal controls, and auditory dependence matters. The Professional Practice Group also assists the Commission in its oversight of the PCAOB, primarily through oversight of PCAOB rulemaking and standard setting, inspections, and the PCAOB's annual budget. Additionally, the Professional Practice Group manages the resolution of auditory dependence and ethical matters that have been brought to the Commission's attention. The Accounting Group leads the SEC's efforts to oversee accounting standard setting by the Financial Accounting Standards Board and to monitor international accounting standard setting by the International Accounting Standards Board. In conjunction with the Division of Corporation Finance, the Accounting Group issues staff accounting bulletins that inform the public or the staff's views on important accounting issues. The Accounting Group also consults with registrants, auditors, and other Commission staff regarding the application of accounting standards and financial disclosure requirements. The International Group provides advice to the Chief Accountant on international auditing and accounting issues and collaborates with OCA's accounting and professional practice groups to provide governance and technical input to international accounting, auditing, and regulatory organizations that share similar objectives as the Commission. Lastly, our Office of Chief Counsel provides legal guidance to the Chief Accountant and the other OCA groups to support the Commission's mission. In addition to its extensive work in rulemaking and other legal policy matters, the Office of the Chief Counsel supports the Division of Enforcement in all aspects of its program related to financial reporting, including recommending disciplinary actions against accountants and accounting firms brought under Rule 102E of the Commission's Rules of Practice. OCA is a consulting office that supports other divisions and offices in the Commission in a variety of capacities, from rulemaking to enforcement matters. Fariba, perhaps you could provide your insights into OCA's role in overseeing the PCAOB?
Sure, I'd be happy to. OCA supports the Commission in its oversight of the PCAOB in various ways. Our oversight activities include supporting Commission appointments to the board, supporting Commission efforts to consider and approve new PCAOB auditing standards and rules, and supporting the Commission's oversight of the PCAOB's inspections program. OCA also assists with the Commission's annual review and approval of the PCAOB budget. With respect to rulemaking and standard setting, for those unaware, once PCAOB rules and standards are approved by the board, a final approval by the Commission is required in order for the rule or standard to become effective. We facilitate the Commission's review and, as appropriate, approval of those standards and board rules. We then make recommendations to the Commission regarding its approval of the standards and rules. Section 19B of the Securities Exchange Act of 1934 establishes the process for Commission consideration of PCAOB standards and rules. Section 19B has long applied to self-regulatory organizations, and the Sarbanes-Oxley Act of 2002, or SOX, applies Section 19B to proposed rules and standards of the PCAOB. In determining whether to approve the standards that were adopted by the PCAOB, the Commission must determine whether the standards or rules are consistent with the requirements of Title I of SOX and are necessary or appropriate in the public interest or for the protection of investors. Additionally, if the new standards or rules would apply to the audits of emerging growth companies, the Commission must also determine whether the application of the rules and standards to audits of emerging growth companies is necessary or appropriate in the public interest, after considering the protection of investors and whether the action will promote efficiency, competition, and capital formation. During 2024, the SEC approved through this 19B process 3 PCAOB standard setting projects. Updated standards on quality control, or QC 1000, an auditing standard on general responsibilities of the auditor and conducting an audit, or AS 1000, and amendments to auditing standards to clarify auditor responsibilities when using technology-assisted analysis. The SEC also approved 2 rules: an updated rule to strengthen accountability for contributing to firm violations, and an update to allow for a procedural mechanism to determine firms' registration withdrawal for repeated noncompliance with certain PCAOB rules. One thing I want to highlight is that under Section 19B, the Commission's review of proposed PCAOB standards and rules includes a notice and comment process. The Commission relies on stakeholder input to help inform its approval decisions. We received and considered comment letters from many different stakeholders on these standards. The Commission's consideration of the adopted standards or rules, including consideration of public comments, is described in the Commission's approval orders. For those who have questions on the standards or want to better understand the Commission's views, I encourage you to read these orders, which are available on the SEC's website. We also support the Commission's oversight of the PCAOB's inspection program. Section 104H of SOX provides the right of a registered public accounting firm to request interim Commission review with respect to a PCAOB draft inspection report under certain conditions. When we receive such requests, they typically come in the form of a Part 2 publication challenges or comment form challenges. The SEC's Regulation P, Rule 140, contains the SEC's procedures with respect to its oversight of the PCAOB, including the procedures firms must follow in requesting interim Commission review with respect to a PCAOB inspection report. Based on the information provided by a requesting firm and the PCAOB, the Commission, as facilitated by the Office of the Chief Accountant, considers whether the PCAOB's assessments or determinations are arbitrary or capricious, or otherwise not consistent with the purposes of SOX. Vasilios, I thought we'd highlight some key reminders that might be relevant for this group. Perhaps we could start with independence.
First, I would like to remind everyone that an auditor, the management of an entity under audit, and the audit committee should work together to monitor the auditing firm's independence and for any dependence issues that may arise. I would like to highlight a couple of topics with respect to independence that our office has seen recently. We have become aware of deficiencies and violations of independence requirements that suggest certain auditors, specifically non-US members of network firms and their personnel, may not sufficiently understand SEC and PCAOB independence requirements, or have appropriate controls in place to prevent or detect independence violations under Rule 2-01. As part of their quality control systems, members of a network firm must carefully monitor non-audit relationships with an entity under audit to avoid situations that may impair independence in fact or in appearance when the SEC dependence rule applies. For example, we have seen that the timeliness of member firms within a network applying SEC restrictions in their independence monitoring system when they are notified of a potential initial public offering varies among member firms within the same network, increasing the accounting firm's risk of potentially entering into or failing to identify existing independence impairing relationships. The earlier in the process that the firm applies restrictions to an entity that may potentially undergo an initial public offering, the better positioned the firm will be in detecting potential independence issues. Another example that comes to mind is the office definition for purposes of application of Rule 2-01's covered persons determination, which can change for a variety of circumstances. One example could arise due to the changes to the other auditors standard that became effective this past year and now requires lead auditors to perform a sufficiency of involvement determination in accordance with AS 2101.06a. The results of this determination could mean that there could be not only a change in office, but there could be a change to a different office in a completely different member network that may meet the office definition of the dependence rule. This determination can trigger certain changes, including who qualifies as covered persons for purposes of determining independence. For example, perhaps a person in a financial reporting oversight role is the sibling of an audit partner who, after an office change determination, is now located in the same office as a new lead engagement partner. When the lead engagement partner was in another office or another network firm, this relationship may have not been an independence violation. But because the new lead engagement partner is now out of the same office where an audit partner has a sibling in a financial reporting oversight role, this previously permissible relationship would no longer be permissible. Without effective controls related to a change in lead auditor or a lack of understanding of independence requirements by the audit firm personnel, an audit firm may wrongly assume that the prior independence conclusion regarding the determination of office continues to be applicable. Similarly, we have received questions regarding whether it is permissible for auditors or registered investment advisors to provide financial statement preparation services in situations when the registered investment advisor uses an audit opinion to satisfy the custody or safeguarding of assets rule, which requires the auditor to comply with SEC independence requirements. In this situation, financial statement preparation services is specifically not permitted by the independence rule. And we have some reminders. We continue to encourage those charged with governance and management to consider the sufficiency of the auditors and the issuers' monitoring processes, including processes that address corporate changes in personnel, but also in corporate transactions or other events that potentially affect auditor independence. An audit firm's monitoring processes should be robust and preventive to ensure the firm understands and assesses its existing clients' affiliates so that it does not enter into prohibited relationships with or provide prohibited non-audit services to them. In the current environment, we continue to see accounting firms seeking to access public markets through new and innovative transactions, including entering into alternative practice structures with private equity firms. This is an emerging area, and facts and circumstances vary. We are available for consultation regarding the application of the independence rules to these type of transactions. I will close with a refresher on the preamble to the auditor independence rules. The preamble outlines general guidance to consider when evaluating whether a set of facts and circumstances give rise to an independence violation. Then it goes on to state that Section 2-01C reflects the application of the general guidance reflecting situations that are clearly inconsistent with the general standard. The rule does this while acknowledging that the Commission could not consider, nor does it claim that all the potential violations are included in the standard. Because of this inherent limitation, it is critical to understand that the application of the auditor independence rules involves judgment. We do periodically update our FAQs with the staff's interpretations of the rule based on commonly received consultations. However, as with any staff guidance, the FAQs are not exhaustive. If the FAQs don't apply to your particular set of facts and circumstances, or if they do not directly address your particular facts and circumstances, we, as a general matter, encourage you to consult with us and are here to help. Pariba, perhaps next we could share, as a general matter, some reminders about related parties.
Yes, thank you, Vasilios. We remind folks that PCAOB auditing standards, both generally and specific to AS 2410 related parties, require auditors to go beyond inquiry. While AS 2410 includes required inquiries relating to related parties, auditors are also required to gain an understanding of the company's process and perform other risk assessment procedures requiring auditors to inspect, observe, and evaluate. While due professional care and professional skepticism are important in all aspects of the audit, there are certain areas, especially those with potential for fraud or other manipulation, where it's especially vital that all members of the engagement team are acting with due professional care and exercising professional skepticism. AS 2410, paragraph 12, provide specific procedures for the auditor to perform over transactions identified to them by the company as related party transactions, including the transactions are consistent with other explanations from inquiries and other audit evidence about the business purpose or lack thereof of the transaction, and determine whether the transaction has been authorized and approved in accordance with the company's established policies and procedures. These procedures, by their nature, require a heightened level of scrutiny and skepticism that auditors should be employing. Continuing to AS 2410, paragraphs 14 to 16, these paragraphs provide requirements for auditors to evaluate the completeness of related parties identified by management and the related requirements in the circumstances where the auditor identifies related parties that were previously undisclosed to them. In evaluating completeness, the auditor should take into account information gathered throughout the audit and consider whether such information indicates the existence of related parties or related party transactions previously undisclosed to the auditor. Clearly, any situations where the auditor is discovering related party transactions that have not been previously disclosed to them by management, the auditor's skepticism and due care should be heightened, not just as they evaluate the specific transactions they identified, but as they consider all transactions and the possibility that there may be additional undisclosed related party transactions. If related parties or related party transactions previously undisclosed to the auditor exist, the auditor should evaluate implications to the audit, including their assessment of internal controls over financial reporting and whether fraud or an illegal act may have occurred. We remind auditors that the nature, timing, and extent of the procedures performed in accordance with these paragraphs should be commensurate with the auditor's revised risk assessment and heightened skepticism. While these requirements are not new, we wanted to provide this reminder to combat any tendency for auditors to rely on inquiries, management representations, or other evidence that, while important to the auditor's procedures, are insufficient.
Thank you for providing these reminders on related parties. Another important topic we wanted to be sure to cover was fraud. It all starts with the risk assessment. A thorough, objective, and comprehensive fraud risk assessment is foundational to the identification of fraud risk. Companies and internal and external auditors have emphasized the importance of a company's whistleblower program as a means for fraud risk assessment. In the Association of Certified Fraud Examiners report to the nations, TIPS was the #1 source for identifying fraud and accounting for 43% of the sources. The next two most common sources of fraud detection were internal audit at 14% and management at 13%. External auditors detected fraud only in 3% of the cases in the study. So, how can an auditor leverage this whistleblower information, which is such a prolific source of fraud detection in fraud risk assessment? It always comes back to the available data and how you use it. I think internal audit reports have long been used by auditors. So today, let's talk about whistleblower data, as it could be an untapped treasure trove of information. Matters of all types can come through a company's hotline, and even those that may seem trivial on the surface, such as, "My boss makes me work too much," can lead to the discovery of meaningful information. If there are a number of these types of reports from one company or specific audit location, it may be evidence of pressures faced by company employees at that location. What does that then say about the broader tone and culture at that location? Did the auditor consider investigating further, perhaps selecting that location for testing? It is also important to consider the potential implications of a company hotline with low or infrequent activity. Is that normal for this company, or could this be a red flag that may warrant further investigation by the auditor? Is the hotline appropriately operated? If not, what does it reflect about the underlying culture at the company? Does the company discourage the use of the hotline? Again, more investigation may be warranted by an auditor. Fraud inquiries of company personnel are an important risk assessment procedure. However, the timing of such inquiries at planning and/or at year-end and how these inquiries are performed could affect their usefulness. One consideration is whether the audit firm personnel making the inquiries is at a position commensurate with the company personnel being interviewed. This is sensitive, as an auditor might be conscious of an imbalance of their respective positions. How so? An audit senior associate inquiring of a chief executive officer does not make sense, but neither does a partner making inquiries of a staff accountant. The robustness of the inquiries will also drive their effectiveness. Instead of asking, "Are you aware of fraud being committed?" consider posing questions related to the task at hand. For example, during a walkthrough, you could ask, "Have you been asked to deviate from this process? Could this process be overridden, and if so, how would you do it?" At a macro level, is the auditor's understanding of the company's business and performance in line with the company's disclosures? If a company is not reporting externally the same way the company considers and reports matters internally, that may be a red flag regarding the existence of fraud. Information derived from a company's financial statements can also be used to evaluate whether there are indicators of fraud risks. For example, how does the company's results compare to its peers within their industry, or the company's own historical performance? How does the company's cash from operations compare to earnings? A business which continues to be short on cash, yet reports growth in earnings, could be a red flag. An auditor should gather this information throughout the audit, and not just at the audit planning stage. How an auditor considers and analyzes the information gathered is also critical. Does this information and the audit team's potential fraud brainstorming meeting yield any other actions, like a revision to audit risk assessment or modification of planned audit procedures? Let's consider a management review control as an example. If you observe year after year that a management review control fails to identify items for investigation, you may question the design or precision of the management review control. We believe that it could potentially be the same for fraud risk assessment and brainstorming procedures. Similarly, if company internal control processes are performed, but never result in identified fraud risks year after year after year, or the same fraud risks every year. This could raise questions regarding their effectiveness. Lastly, it is also important for the auditor to consider all information gathered and pay close attention to an issuer's approach to its own fraud risk assessment when evaluating the issuer's control environment. Pariba, shifting gears a bit, could you please touch upon how the Division of Enforcement, in consultation with OCA, supports the Commission's mission of protecting investors to instill public trust? And are there any learnings from recent enforcement actions?
Of course. Throughout the SEC's enforcement process, our colleagues in the Division of Enforcement reach out and consult with the attorneys and accountants of OCA on whether potential violations of accounting, financial reporting, auditing, or independence standards have taken place. This coordination between SEC enforcement and OCA not only protects investors by holding bad actors accountable, but also informs the Commission's standard setting and rulemaking processes. A topic we are often asked about is internal control or financial reporting implications when considering errors in previously issued financial statements. As a reminder, in addition to assessing whether an accounting error is material, an entity similarly must evaluate holistically and objectively the severity of the related control deficiency. While this assessment may use the actual accounting error identified as a starting point, it must consider the magnitude of a potential misstatement and what could happen in the context of current and evolving financial reporting risks in determining the severity of the error and any underlying company internal control deficiencies. While a material accounting error is a strong indicator of a material internal control weakness, a material internal control weakness also may exist without a material accounting error in the financial statement. In this respect, when conducting an ICFR assessment of a revision or little r restatement, management or the auditor may be tempted to focus on the immateriality of the accounting error in each of the prior periods and conclude that a material internal control weakness does not exist. However, we want to highlight the judgment involved in this assessment, and management and the auditor should perform an assessment of the accumulating nature of the accounting error, or the accounting error's quantitative impacts on all relevant financial reporting periods, for example, and also related qualitative factors. We also want to highlight that materiality is not in itself a rationale for management to override GAAP. For instance, if the application of GAAP results in a presentation that a company's management does not like, it would be inappropriate to simply say the departure from GAAP is not material, override the accounting guidance, and let the analysis end there. For clarity, we want to note that this scenario is distinguishable from a situation where a company has a predetermined policy that departs from GAAP, such as not capitalizing certain de minimis office equipment, when there are effective controls in place to monitor the impact is never material. In both the little r and management override scenarios, when the company and the auditor perform their assessments of ICFR impact, in addition to the assessment of materiality, the impact on ICFR should include not only consideration of the control activities that directly failed to timely identify the accounting error, but also consider whether there is an indication of a broader entity-level control deficiency. In the first scenario, the length of time the error continued to go undetected may indicate a monitoring or risk assessment deficiency. And in the second scenario, whether the management override may indicate a control environment deficiency as a result of the tone at the top. These types of situations are judgmental, requiring holistic, robust, and objective analysis of the quantitative and qualitative factors. Vasilios, in addition to evaluating the ICFR implications of an error, issuers and auditors need to remain objective in assessing whether an accounting error is material. Can you highlight a few thoughts on this topic?
Yes, thank you, Fariba. As we emphasized in the past, the determination of whether an error is material is an objective assessment focused on whether there is a substantial likelihood that a reasonable investor would consider the error important in making investment decisions. We have continued to observe a need for registrants and auditors to be more objective in their materiality assessments. OCA will continue to be skeptical of arguments that appear to be biased towards a conclusion that errors are immaterial, such as an argument that investors only care about non-GAAP metrics. We have at times been presented with analyses that conclude an error in disclosures, such as in the cash or non-cash disclosures required by ASC 230 or segment disclosures required by ASC 280 is not material because it didn't impact the face of the financials. In certain instances, the staff has objected to a conclusion that a disclosure-only error is not material. In this regard, I would remind the audience that disclosures are an integral part of the financial statements, and the correction of an error within the notes to the financial statements can be a material error if the information is material to investors, even if consolidated amounts reported on the face of the financial statements are not misstated. In these fact patterns, just as we assess errors to the face of the financial statements, we consider both quantitative and qualitative factors to determine whether there is a substantial likelihood that the disclosure error would have been viewed by a reasonable investor as having significantly changed the total mix of information available to that investor. So, to sum up, as Fariba talked about, all of these scenarios are judgmental. Materiality assessments by both registrants and auditors should be approached with objectivity, taking care to avoid any potential bias to ensure the assessment is from the perspective of a reasonable investor. Fariba, while we have talked about the importance of an auditor being objective and unbiased in the context of materiality assessments, I think this is an area that has broad applicability across the audit. And to support an auditor's ability to exercise professional skepticism, it is critical for a firm to create an environment in which auditors can do without hesitation. Can you share a few thoughts on this topic?
Yeah, thank you, Vasilios. A strong culture and tone at the top that prioritizes doing the right thing above all else empowers all accountants. Regardless of their role or level of experience, it empowers them to exercise professional skepticism and, where appropriate, to challenge management. Some recent academic research shows that behavior is driven the most by the people that are directly around you, which some refer to as the moon in the middle or the buzz of the bunch. For example, an academic study specific to auditors showed that staff auditors will be more influenced by the tone of their supervising senior than the partner when these two individuals provide conflicting tones. While the study is for auditors, the behavior may be agnostic. It could be applied to issuers or at the audit firm level or at the engagement level. We raise this topic because we think there may be a tendency to overly focus on tone at the top and perhaps assume that the tone will naturally flow down. However, the tone at the top may not be reaching all levels of the organization. Operationalizing tone at the top so it flows downward to individuals and teams can manifest a good ethical behavior, which has an impact on decision making and integrity of professionals. Good ethical behavior and a strong culture at the engagement team level can be observed in many ways. For example, supervisors in their roles across the accounting profession can create an environment in which it is acceptable to ask tough questions. When staff observe their supervisors' healthy skepticism in asking of probing questions, they are more likely to feel empowered to do so themselves. A staff's hesitation to be skeptical and ask follow-up questions may manifest in the form of nonverbal cues such as facial expressions or body language. By paying attention to and acting on such cues and by encouraging staff to be skeptical, supervisors can facilitate further dialogue on any topic at hand. The benefit of a staff's fresh eyes may bring something new to light for further investigation. All of this is good for audit quality. Audit staff may also feel empowered to exercise professional skepticism when they have the unwavering support of the engagement team and firm leadership. Unwavering support for staff's efforts, such as increased time spent investigating a matter, should not be bound by whether a question or procedure may lead to a finding. These efforts should be applauded as they demonstrate appropriate professional conduct. Just a final thought on this topic, when less experienced accountants' professional experience is anchored in doing the right thing, they are more likely to become leaders with this same mindset.
Thank you, Fariba. Technology is another area that has received significant recent attention from practitioners, preparers, standard setters, and regulators. We have observed rapid advancements in technology as preparers and audit practitioners alike embrace technology-driven innovation such as generative AI, remote observation tools, and sophisticated data analytics. These advancements present exciting opportunities for the profession as the increased use of technology is creating efficiencies and allowing for staff to spend more time on areas that require professional judgment and critical thinking and less time on more mundane tasks. I believe this creates significant opportunity to attract new talent to the profession. However, these advancements also present unique risks for the auditor and preparer to consider when using technology. For instance, special consideration should be given to information technology related controls, obtaining sufficient appropriate audit evidence, and the entity's data retention policies, among others. Data analytics is another area that we are very interested in. How do investors receive and consume financial information? We work closely with our colleagues in the Division of Economic and Risk Analysis who are focused on issues like machine-readable data. Financial investing and analysis heavily rely on data as the foundation for making informed decisions. Technological innovation has allowed investors and others to automate data consumption for use in evaluating companies, assessing market trends, and managing risk. The staff works closely with the FASB's taxonomy team on updating and maintaining the US GAAP financial reporting taxonomy. Specifically, SEC and FASB staff meet periodically to discuss ASUs and the associated impact on the GAAP taxonomy. As you may know, filers are required to submit inline XBRL data for their financial statements and notes. Filers use the GAAP taxonomy to make their financial statements and notes machine readable. The benefits of machine readable data extend beyond investors and can be used by preparers as well as auditors. For preparers, it could enable the automation of disclosure review and peer analysis and allow filers to quickly extract data for analyzing their own results or researching how their peers treated an accounting transaction. For auditors, machine-readable data could help in identifying disclosures that are present or missing. Because tags are linked to the specific disclosure requirements in the accounting standards codification, if a filer has revenue, for instance, the auditor can search for tagged disclosures using the tag ASC606 to identify which revenue disclosures are tagged in order to verify existence of disclosures and the proper presentation of financial information. Speaking of all these use cases drives home how now, more than ever, the accuracy and completeness of data, the tagging, is essential because of all the ways it is used by various stakeholders. If the foundational data is not accurate, then the decision usefulness of the results from the tool diminishes. Fariba, on a separate note, could you share some reminders related to financial reporting in the current economic environment?
I'd be happy to. All of our work is grounded in the SEC's mission, including investor protection and the basic approach in our federal securities laws that investors get to decide what risks they're willing to take, while companies raising money from the public have an obligation to communicate with investors in a transparent manner. This also improves the efficiency of the markets and capital formation. In order for this basic premise to function, however, companies must provide investors with information that is consistent, comparable, and useful in making capital allocation decisions, while auditors must perform high-quality audits and maintain their independence from audit clients. Management, internal and external lawyers advising management, auditors, and those charged with governance should be focused on communicating material, financial, and non-financial information that is relevant, complete, and accurate to enable investors to make informed capital allocation decisions. While registrants must operate within the bounds of and comply with applicable rules regarding the form, content, and delivery of information, we must remember that corporate reporting is also a communication activity and not solely a compliance exercise. This is especially relevant as the national and global economic outlook continues to evolve. I would remind issuers and those advising them of their responsibility to transparently disclose information about assumptions and material uncertainties in a way that helps investors understand how significant risks and estimation uncertainty affects the financial statements so that they are properly equipped to make informed investment decisions. Vasilios, is there anything else you want to cover before we wrap up today?
No, I think we have covered a lot today. So this concludes our presentation. Again, it was a privilege to speak with you today, and we look forward to continuing to engage with you.